Hello, fellow traders. Curtis from Beyond Backtesting here. Today, I want to just do a quick topic on the Robbins World Cup futures trading competition. For those who don't know, Robbins World Cup futures trading competition is a real money futures trading competition. It's been going on since the 1980s, early 1980s. It was made famous by Larry Williams. It's a real money futures trading competition. It is probably the most respected. I think it's the most respected futures trading competition in the world. I think it has the highest it's the most respected by me, the most well known, certainly, and I have a lot of respect for it. I don't know why that date's there, interchange. Maybe I did that. At any rate, it's again, highly respected competition. Not trying to take anything away from this competition. I've certainly considered entering it in the past, but consider entering it in the future, even today. But what we're trying to ask here is: this the best futures? Is this truly the best futures return possible, or are there some other factors that we need to consider? So first, so I have respect for this, and obviously one of the reasons traders do take this is because it's very hard to establish yourself as a professional in futures trading. Going the CTA route, can be very expensive. It's very difficult to get customers or clients, whatever you want to call them. And so I think it's a great service that Robbins is offering. Certainly would consider taking in the future myself. But if we're looking at this performance, it doesn't make sense to look at this without looking at all the details. And doing that is really, again, doesn't make sense. So when we look at the details, okay, it's a 10K real money account. And here's your cost structure. It's $5 per side per E-mini, plus your NFA exchange, NFA processing, transaction, etc. fees. And so that's going to put you at $10 per round. I don't know how much these other fees are, but I do know for a discount broker, those other fees are significantly more than your commission. So I'm going to probably say $12.50. I'm going to guess $12.50 to $15 per round is what your all-in cost can be per round. Now you compare that to a discount broker like discount broker like AMP, you're all in is $3.80 per round turn. Okay, so even if you round that up, it'd be $4. You could probably even do better in this if you was a frequent trader or if you had prop trading, seat lease. So you're looking at 3 to 4 times the cost. Okay, your cost. And if you know anything about frequent trading, this pretty much means you're excluding active frequent trading from this competition. And because of that, I think that we can't make any conclusions as to compare this to a frequent day trader or an active frequent trading program that's very active because of the fee structure. So what I would say is we could probably say it this way: this performances, especially the better performances, are probably a high watermark for what you could expect to achieve trading futures if this is your trade cost, or if you're in this trade frequency such that these trade costs are insignificant. If you're in that type of a trading frequency, trade cost range, this is probably a high watermark of what you could expect to make. However, I don't think it tells us anything about what an active day trader, active futures trader who's trading several rounds per day, very actively trading, can make with this type of fee structure. Okay, I don't think this tells us anything about it. It'd be nice if it did, but I don't think it does. And if we believe that anybody can actively trade futures for a living income, these returns, most of these returns are probably not going to do that, right? Some of them do. Some of them are very outstanding, like Larry Williams. Some of them are outstanding in any regard. Keep in mind also another factor I like to think about that's on my mind as well. When I think about this is that futures are highly leveraged products. Of course, you got the macros, but these traders are probably not trading that. And with a highly leveraged product, you're probably going to make a 50 to 100% return or blow out. You can just structure your trades so that you either make 50%, 100%, or you blow out. And given that this is a winner-take-all competition, when I see a return that's anything less than, say, 200%, just from the fact that the contracts are so leveraged, I don't think that can be considered world-class, simply because it'd be so easy to produce that by chance. Not by pure chance, but just by taking a system that's a good performance system, hitting it with a good run of luck, so to speak. I have performances on track performances of 50% recorded for a future system. I wasn't even trying to trade it at the competition level. So I could have produced a quote unquote world class competition with that system during that time period just by increasing the leverage potentially. So again, what I'm saying is basically with a certain leverage, you're going to either blow out or make 100%, or you're going to. So you have to do more than that to be impressive. In some respects, you have to get beyond that what you could do just from a leverage perspective. So I don't know mathematically where that is, right? I believe it's around 500 to probably 1,000%. Though I think that's where it's around. I've looked at it before, but so anything under that 400 to 500% is probably still in that range of chance, in the sense that you could have done this just by chance. I don't know if that's the case. Obviously, it depends on the specific trade frequency and stuff, but you could certainly take a system that was a good system, say a system makes 30% per year, hit a good run on it, and blow that performance up to something incredible just by hitting a good run on it. And so that's a statistical type of question. But so yeah, I would say this is probably a good performance, a high watermark if you're in this group, but most of us are not, right? And if you're actively trading futures, it doesn't tell us anything, but we can see. It's a $10,000 account, and if you take $10,000 account and you're risk 7% per day, now someone's going to say, well, that's a huge risk. This is a competition. Keep in mind that. Also, keep in mind that if your risk of blowout, and you can validate this by running Monte Carlo simulations, if your risk of blowout is minuscule or basically zero at say 2 or 3%, then increasing your risk just a little bit more, it's not going to increase that, right? It's not going to increase that significantly. What's more important is your consistency in all this, and what's relevant is that your statistics a lot of times don't hold up in futures, and more than the risk itself. But assuming you can trade with some kind of consistency, this is probably for elite trader is in the realm of possible, and for elite trader, probably asking to do 50% of that is probably not excessive. So we'll do a little less than 50%, so $300 return. And now we do that $300 times approximately 240 trading days. Okay, gives us 72%. Let's say you don't trade every day, whatever, that's impossible. Maybe miss some days. We'll put it 75%. So it gives you a $54,000 return. And obviously, and this is about scaling though. So that's a 540% return. Obviously, I didn't take into account losing days, but let's just say you do 65%. Let's say you do 60% of that. That's 32,000. Okay, you're 320%, but you're not scaling. So again, this is just kind of guesswork, but even with this performance, you could see you would be winning a lot of the years, not every year. Some years are very impressive. I think anything over that 400 or 500% is probably impressive, regardless of how we look at it. But even if you look at performing, keep in mind this is a competition. You could risk the entire 10K per day. But let's just say a trader who makes risk $700, it makes $100 per day, right? Times 240, that's a 240% return, just $100 per day. And so, again, what does this mean? Not a whole lot. It just means that I think that we cannot infer these results are not, doesn't tell us about this type of a trader, right? What this type of trader can make. However, if I were to say what this type of trader can make, we can make some assumptions. We can make some guesses. First, I would say that a trader is, if you're winning 70% of the time, you probably don't need much more than the amount in your account that you intend to make. So, for example, with a 10K competition, that would infer you could probably average 10K. On average, you would probably not need more than 10K in your account, and that would, on average, give you 120K. And the reason this is the case is simply because your risk and reward is about the same. You're trying to make 10K, you're risking about 10K, and the whole idea is that you're winning a percentage more. And if you're not consistently making money, then if you're able to consistently make money, then how many months are you going to be down? So this is assuming you're not down more than 1 month, return. So this kind of makes sense to me. Again, it's probably optimistic, but it's also probably on average realistic for an elite trader, assuming you can do that 70% win ratio in that range. That would be one type of an estimate. Another type of an estimate would be to take your max risk, and let's take that at 7% and $700 per day. Okay, well, this is about scaling, and let's just take that you win every day, the same amount you could risk. This gives you 168K performance. Okay, this would be your theoretical maximum without scaling on a 10K account. So that's 1,608%. But again, scaling makes a bigger difference than this, because you can actually scale in this competition. But if this were the case, right, then we have to figure out, you try to infer, okay, what percentage of maximum could you achieve? Let's go something very modest, 30%, a maximum 35%, 58K. Okay, you're still at that 508% range, 58K. So again, this is just guesswork. But I would say keep in mind that this fee structure means that it's going to eliminate most of your active traders, your day traders, and so again, even prop traders have better rates. So I don't think we can really infer this much. You can also look at the notional values, et cetera, et cetera. There's lots of ways of doing it, but essentially, if there's anybody day trading, they have to achieve a certain level of success, a certain level of consistency with that, and the returns implied would be much greater than this than most of these years. Some of the years would be probably in that range, but it's 500-600% range. Maybe it's 1200% range. But yeah, okay. So take it for what we will. But it just helps to know that it's worth it to understand what went into producing this and why this may not be representative for all traders.